Welcome, welcome, welcome to a Get Keys with Kim production, where we discuss all things real estate, legacy and wealth building, community development, and engagement. Don't forget to follow me on Facebook, Instagram, LinkedIn, Spotify, and my website, as well as to share this podcast with your network. And just as a friendly reminder, this podcast should not be considered legal advice unless otherwise stated. Get Keys with Kim does not endorse, approve, recommend, or certify any information, product, process, service, or organization presented or mentioned in this podcast. I hope you enjoy.
That's the one tricky part with the bank statement loans or the 2-1 buydowns or any the non
specialty. Yeah.
Is they're so specific, and that's what it all leads back to that first step, that initial conversation and learning about the goals of each person. Is every single person is going to kind of have their own story, what they want, what they need. And my job and, people in the industry like myself, what we try to do is just get a 30,000 foot view of that person, that story, and find the best solution for it.
And I always tell folks, be honest. If there's one person to be honest with, it is with your lender. And I always use this phrase, you vibe with your tribe. Go where you feel comfortable, because you're going to have to divulge and share information about your life. And for most people, it's their finances are probably the most coveted thing. You don't usually want to tell people how much you make. You don't want to tell people what you're spending your money on, where your money is going. You have to have these open and honest conversations with yourself up front. I was in a situation this week where, I'm listing a home and a buyer puts in a contract and then they pull the contract back because they're like, you know what? I just spoke to my lender and I realized that I don't really want this payment. We should have been talking about payment day one, hour one, because you don't want to waste your time. This market is ever changing. And even though the inventory is low right now and there's not a lot of buyers, and sellers are probably more willing to do things like closing cost help or seller concession, it's all the same thing, right? They can be used interchangeably. We are still seeing multiple offer situations. We're still seeing buyers that are having to put their best foot forward when they're putting in their offer. And their best foot forward is not always what we saw in the pandemic, where people were, offering 50, 100,000, 25,000 and waiving inspections on. But you have to put your best foot forward, because once you're under contract, you can't say, I don't want that payment, so now I don't want to buy this house. So just be upfront and honest with your lender. Have that conversation. That's why I love when you said in the beginning, Kevin, what are your goals? What is the plan here? If this house is meant to be, your stepping stone house, your base, so that you can then get an Airbnb, so that you can then, build a family, whatever you want to do, then you might move differently with how you purchase and the loan product that you would choose. So just, be open and honest with your lender.
No, for sure. I always tell people, how much money do you have, for the purchase?
Right there.
Yeah. I don't care if you I don't care if you make, I don't care if you got 100,000, but you only want to use 0. You tell me, and I'll help you get to it.
And we'll figure it out.
Figure it out from there. It's not my money.
So yes, I want to talk about that before we get into down payment assistance and closing cost assistance and things like that. You mentioned that with the 2-1 buydown, that could be a seller credit. And so I do know that with different loan products, so with conventional, you mentioned, a buyer can only get 3% in seller help. If it's FHA, they can only get 6%. USDA, same thing. So let's just say the buyer needs help with the closing costs, but they also want to buy the rate down. Is that seller credit still maxed at, let's say, 3%? We'll use conventional.
Yeah. So the only one it wouldn't be would be VA. VA is a little bit different, guidelines of what the 4%, and for VA is 4%. What it can go towards. For conventional, if you're putting down 10%, you can get 6% seller credit.
Okay.
You put down 25%, I believe it's 9%.
See, now I didn't know that. So the more you put down, the more.
Yes, the more you can get back. So.
Your girl is learning something.
Yeah, so those are good, especially if you're running inspection issues or anything like that. Hey, we'll just get a seller credit. We'll deal with this on the back end. But they put, 10% down and get an additional 3% to help cover.
Now, y'all, I'm not saying you need 10%, right? The common misconception or common myth is that you need 20% down when, depending on the loan product, is definitely in the single digits, it's usually under 5%. However, if you're looking to go non-traditional routes, right? You're looking to get seller help and things like that, or go with non-traditional programs or non-conforming, as Kevin has said, then talk with your lender about that, because that could mean that you're putting more down, but you may be getting more back. So it just all depends. All right. So this is one of my favorite conversations. There are some lenders that I know that don't like to talk about what we call DPA, or down payment assistance. There's something called closing cost assistance as well. Can you tell the folks a little bit about that, and maybe some products and services that you offer that may be able to assist those that, may not be cash heavy?
For sure. So
nudge.
The down payment assistance is awesome. I laugh when people don't really want to talk about it too much, just because if it's framed properly, it's not a negative. Like, we can close down payment assistance programs like through Maryland Mortgage Program, which I'll get into in a second, within 30 days.
Yeah.
So common misconception, takes longer. Like, really doesn't. The only difference is sometimes we're dealing with the state. We're dealing with a third party that we got
right.
And
they have
if they're delaying, we can't necessarily get to them right away. So, I get it, but we're closing Maryland Mortgage Program within 30 days pretty frequently. Maryland Mortgage Program is the biggest one. So,
okay. What is it?
It is a state-funded down payment assistance program.
Okay.
A handful of different options.
Gotcha.
From as little as $6,000 down payment assistance, and that down payment assistance will help cover down payment and closing costs.
Oh, okay.
Or both, or whichever.
So it can be used for both down payment and closing costs.
Yeah.
So really quickly for the people, what is the difference? I've talked about this previously, but for those that may not have listened before, what's the difference between down payment, what you need for a down payment, and closing costs?
Yeah. So down payment is usually the minimum that you have to bring to the table.
Okay.
So for
who makes that rule? Is that per bank? Is that?
Yeah, so that'll be through like the Fannie Mae, Freddie Mac, or FHA. So for FHA, for example, the borrower has to bring their own down payment to the table.
Okay.
So for example, if you get the 4% down payment assistance loan, that's your down payment assistance program. So that covers your 3.5% down payment for FHA. Say you get the $6,000 down payment assistance program, down payment is $7,500. In that scenario, you would have to come out of pocket $1,500 minimum
to cover.
The borrower has to come with the funds of the down payment themselves, whether that's their own money or through down payment assistance programs.
Or like a gift. So if I want to
work as well, yeah. So it just has to be your funds. It can't be through seller credit.
Gotcha. All right. So what happens? So you talked about the deficit, right? If it was the 6,000 down payment assistance program and it's really 7,500, they're coming to the table with 1,500. With the example that you gave, where let's just say they have the 4%, they get the 4% down payment assistance, but they only needed 3.5. What happens to that 0.5%? Does that go to closing costs? Does that come back to them? Or?
Yeah. So it would go all throughout the closing.
Okay.
It would just work the closing costs to get you to as little as $0 to the table.
Yeah.
So if you've ever heard someone say bought a house with no money down, it was most likely down payment assistance program combined with seller costs. Those two combined would lead me to say that 90% of the people that bought a house with $0, use those two if they weren't in USDA or VA loans.
Right.
So Maryland Mortgage Program, that money wouldn't go back to the borrower. It would just go to closing costs.
Gotcha. Okay, so we have Maryland Mortgage Program. For those that are not in Maryland, your state may have, a similar loan product. Kevin, where are you also licensed in case they're not in Maryland?
So I can do most of the East Coast, and our company, most states, most states. So myself, I can do Maryland, Pennsylvania, Delaware, New Jersey,
Okay.
DC, Virginia, Florida, North Carolina, Ohio, Michigan,
Oh, wow.
Alabama,
where all the best schools are. Okay.
Colorado. I think that's it. But
And that's a lot.
it is a lot. So those are the ones. I can't do Alaska quite yet. I tried, but
Okay. Alaska's coming. Listen.
yeah.
Somebody needs help with getting a house to protect them from the bison. I mean, I don't know. I don't even know what's in Alaska.
I used to live in Alaska.
Did you? Oh, see, now that makes sense. So I'm sitting here in my mind like, why would he want to do Florida? I can see. Alaska. Okay.
I spent a year up in Alaska. I had a buddy reached out to me. Went to our sales VP and was like, "How do we get our company licensed in Alaska? Do you have more than one deal?" Not yet, but we're probably not.
Listen, you got to speak it. You got to name it and claim it, Kevin. If you want to be licensed in Alaska, you'll be licensed in Alaska. That's going to be my prayer for you tonight, that you'll be licensed in Alaska. And go ahead, just give me a shout out on your page when it happens.
A lot of continuing it and 4 hours.
Well, here's the thing. I mean, off on a little bit of tangent. Like there are lenders that I've worked with before. They're in Maryland, but they're like underwriters. We're in California, so we were behind like.
Oh yeah.
So what's a few hours? What's a different time zone? It's not too much. Okay, so we have the down payment, which is not necessarily individual lender based. So Wachovia doesn't exist. So I'm just use Wachovia. So it's not like something that Wachovia says or Bank of America says. This is federally. This is what federally, if you want to take advantage of these particular programs, they're saying that this is the minimum that you have to bring to the table. It has to be your money. It cannot come from the seller, but it can be a gift. It can be from your tax returns. It can be from a trust, as I say, or it can be from, I don't know. What do you call those? 401ks. Yeah, things like that. Your closing costs then, so if that's the minimum you have to bring, that's your skin in the game. That's the minimum you have to bring to the table. Why then are there closing costs? What is included in that?
So back to the lender costs, the taxes, title work, any discount points that you have on there, credit report, your homeowner's insurance policy for the first 12 months. All of those closing costs plus your down payment will equal your total cash to close. So, let's say that's 7%. So 7% of the purchase price. If your down payment assistant covers 4%, there's 3% left over that you have to cover. You can cover that by either covering on your own through gift, through any of those vehicles that you mentioned, or seller help. And if you get that seller help, that's when you can kind of get to the table with that no money down. And, like yourself, you get kind of that surplus. That's when your agent can get home warranty.
Yes.
So any stuff like that, or you get a surplus. Hey, Kev, we got, 4% seller help. I only need it. Well, let's take that 1%. Let's buy down the interest rate more.
Yes.
Now we kind of get the best of both worlds. And that's when you can start getting real strategic and finding the best use of the money. And we'd want to find out with the buyer, like, is the lower payment important
what
to
you're
you?
looking for, right?
The warranty more important to you? Where does this money go that works best for you? And kind of put our heads together.
And that's what you need, a creatively legal lender, right? We're not here trying to give you suggestions and strategies that are going to, put you in a position where you're, getting locked up for mortgage fraud or something like that. Like, these are legal avenues that you can use in order to support your dream. It is extremely important. And for those that are not familiar, because sometimes I know we throw out terms that I'm used to hearing them all the time, but for those that are not familiar with home warranties, that used to be my jam before the pandemic. Like every offer, I'm like, we need a home warranty. But basically a home warranty would cover everything that is not covered by homeowner's insurance. So it's more like your appliances and your systems. And some will even cover like your pool liner, your ceiling fan, your dishwasher, your washer, your dryer, your HVAC system, your microwave, your stove. If those things, you basically pay into it either annually or monthly. And then when it's just like car insurance, right? You pay into it annually, monthly, or quarterly, however you pay into it. And then if something should come up, you pay a flat fee for a vendor to come out and check out what the issue is, and they should be able to fix it. And if for whatever reason they can't fix it, the home warranty company will cover the replacement of that product. So it's basically car insurance for your house appliances. It's not to be confused with homeowner's insurance, which covers your valuables and the loss based on theft or vandalism or flood or fire or something like that. That is your homeowner's insurance. You do have to pay that up front. That is part of some of those fees that Kevin had mentioned before. Home warranty is extra. That is not required. I always suggest it, at least for if the seller is willing to pay, at least for the first year. You never know, right? So that's what we mean when we're talking about home warranties. Okay, so you mentioned Maryland Mortgage Program, that it has different products even underneath that umbrella that can and will cover your down payment and closing costs. Your down payment is the minimum that you're bringing to the table. Your closing costs are the fees that we've talked about before. So other than the Maryland Mortgage Program, what other programs may be available to those that need that down payment assistance?
So we got Hometown Heroes for like
okay. Okay.
$5,000 that down payment assistance program. So
okay, Hometown Heroes.
Yep.
First responders only. So that's who's included in it.
First responders.
So firemen, paramedics. Yeah. Oh, police are in there. The nurses. No, come on, y'all. It's not you. I know. I'm not going to shoot the messenger on this.
I'm upset. Listen, I've been fighting.
Gotcha. They need to be.
World War II.
Okay. So, all right. So we got our firemen, our paramedics.
DML, we have our own specific down payment assistance program that can go up to 4%.
Okay.
That is not to one specific group.
Okay.
It kind of coincides with Maryland Mortgage Program.
Okay.
The only difference is that the one we have in-house will allow for a borrower that makes above the income. So kind of back
above the Maryland Mortgage Program limits?
Yeah.
Gotcha. Okay.
Which I believe is $119,000.
Okay.
Somewhere there. So that would be the one for us that we kind of have right now in-house.
Okay. That's $5,000.
Yeah.
Okay.
Sorry, that our in-house would be 4%.
4%. Okay.
The highest that Maryland Mortgage Program does. And then once you get into like the city of Baltimore, there's just a plethora.
There is a bunch.
Live where you work.
Mm-hmm.
You know,
CDBG. FHLB.
Yeah.
City employees. Yeah.
City employees, vacant.
Vacancy value. Yeah. I tell everyone, to each his own. We're not trying to push you in any particular direction. Every county within Maryland, I believe, has their own private version of it. So we have statewide, we have the Maryland Mortgage Program that covers all of Maryland. And then each county then has some type of support, usually at least about $5,000. So and I know you can't tell us the requirements for every single thing. Oh, what were you saying?
Greenbelt right now is, Maryland Mortgage Program is doing a special product in Greenbelt.
Okay.
Go up to $15,000 for anyone who has rented in Greenbelt for the last 12 months that's buying in Greenbelt.
If you rented in Greenbelt.
Rented in Greenbelt for 12 months.
Prince George's County.
Buying Greenbelt.
Mm-hmm. Okay. Up to $15,000.
Correct.
Wow. Towards down payment or closing costs.
Towards it all.
Y'all, if you living in Greenbelt right now, okay, and you want to, Just get with me and Kevin. Kim and Kevin, okay? Just get with us because we're going to take care of you. I'm going to put this out on my social media this week. So when y'all see it, y'all know. All right, Greenbelt. Y'all better come through, as they say. All right. And then what is the Home Ready program?
Home Ready is a program that will allow borrowers to put down 3% for conventional. So you mentioned earlier that common myth is 20% down, which is still very much a common misconception.
Okay.
The new is 5% down. Well, okay. 5% down either. If you fall into the Home Ready category, you can put as little as 3% down.
Okay.
So, Home Ready also got spiffed up a little bit this year. Things that are great with it. One, you qualify for Home Ready if you make less than 80% of the annual median income.
Okay. Where? It's by county?
County.
Okay.
Yeah, so by county, by zip code, it would go by. So in Baltimore County, for example, 92,500.
Okay.
That number is like right around that mark.
And that's for everybody in the house. So if we're talking about spouse.
Yeah, it's for who's on the loan.
Whoever's on the loan. So if it's you and your wife, Kevin, and you decide only to be on the loan, that 92 is only going to be for you, even though your wife's going to be living in the home.
The Maryland Mortgage Program will do household limit.
Okay.
Home Possible, which are similar products, they'll just go off the loan.
Gotcha.
So
all right.
Household income. Now, for first-time home buyers, you can go to 100%. So first-time home buyers who make less than $116,000, they fall into the Home Ready bucket now as well.
Gotcha.
So that's been pretty awesome. Home Ready borrowers can put 3% down. They get better rates for mortgage insurance.
Mm-hmm.
They're going to get better rates, cost to the rate for mortgage rate in general. It's just a fantastic program. The only requirement that is much different aside from like that first time home buyer part to make over 80 would be doing a home buyer education. So
gotcha.
Just doing a home buyer education course, you can do it online. I think it should take you 3 hours if you're watching the game on your laptop.
Yes. Okay. So can you stack some of the programs that we've talked about and even the ones that we haven't? So you mentioned that Home Ready, Home Possible were kind of like the Maryland Mortgage Program. Their thresholds were a little bit higher so you could, get more people into those programs. Could you combine them with the Maryland Mortgage Program? Are they separate? How does that work? And are there any credit limitations or restrictions? Like, do you have to have, or let me not say limitations or restrictions, requirements is the word I'm really looking for. Are there any credit requirements for these programs?
Great question. So Maryland Mortgage Program requires a 640 credit score at minimum.
Okay.
So you need a 640 credit score to qualify, and then from there, once you qualify for the Maryland Mortgage Program, then it's just you qualify for the loan, whether it's
gotcha.
Home Ready or whether it's FHA. So as far as stacking, you can absolutely stack Home Ready with the Maryland Mortgage Program, which is why most times when we're doing conventional Maryland Mortgage Program, it's Home Ready borrower, 3% down, get the 4% loan, which covers their down payment plus 1% of their closing costs.
Gotcha.
With FHA, same thing. You can stack it. As far as stacking grants, once you get, especially the city, like we just start stacking them. The more you stack them, it falls back to that timeline as far as making that 30-day close might be a little bit challenging.
Gotcha. Because you're dealing with outside entities, right? It's beyond you at this point.
If you put 3 at the same time, it would be 4 loans trying to go at the same point. But I, especially like living near where you work in the city, I'm usually stacking that with CDBG almost every time, if I can, because at the point we're getting one loan, like let's just get that thing down to 0, bring no money to the table, and get in.
And that's a beautiful feeling, right? I tell buyers that you're going to pay something, right? There's something called an earnest money deposit that you have to put down as a good faith deposit. You put down with the contract. You're going to likely pay for a home inspection. That's going to run you between $300 to $500. Sometimes my clients will get a re-inspection, and so that'll be an additional fee. Some loan programs, not loan programs, but incentive programs within the city, they require a secondary inspection called an HQS, or Housing Quality Standards. So that may cost you extra because that's additional paperwork that the home inspector may do. So, I mean, it's not completely free, y'all. But if you can, there's the opportunity to stack these funds to make home ownership possible. I mean, we could go on and on. Like, we really had like 42 questions, but we've narrowed them down to 21 today. It's probably a little bit more. I mean, we've covered everything from what is the process for getting pre-approved. Yeah, go ahead, Kevin.
I want to cut you off, but you mentioned as far as stacking, like, and a lot of the programs too. If we stack them, like, seller helps involved, we can get back the earnest money deposit. So if you put in like $1,000, get seller credit, you can get that $1,000 back.
I like a good refund.
Yeah.
Especially when it's not at tax time. Like, go ahead, surprise me. You know, and I've had situations where I've had clients that were owed money back, right? Like, we got not too much money, but a good port. Like, we stacked a lot of different programs. You know, the programs didn't allow for them to get the money back, but it was truly a good feel. Like, we were able to get them home warranties, just other things that they needed in order to prepare to be new homeowners. And so you have to be with a lender that is creative, that's going to think like that. You know, we don't want to send any money back, so to speak. And one thing you did say, I wanted to make sure that we covered it. You mentioned grants and you mentioned loans. When it comes to down payment assistance, what is the difference?
Very, very good question. So a loan, especially through the state of Maryland, we use Maryland Mortgage Program for the example. A loan is going to be a second lien placed on the property.
Okay.
Something that you will owe back at the time of sale or the time of refinance. So at the point that you sell that loan, whether it's selling your house or refinancing, you will owe that $6,000, $10,000, $12,000, $15,000 back to the state of Maryland. You don't pay it out of pocket. You pay it from the proceeds. If you're refinancing it, you would then write a check if you needed to, or wrap it into your loan cost. That is what the loan portion is. 0% interest. You don't owe monthly payments on it. You can't sell your house and forget about it. It's going to be attached to the title. So, like, nothing to really worry about as far as, like, having to remember. Nobody's going to let sell a home without telling.
Oh, the government is not going to let you forget. Okay, so you may forget about it.
Yeah. So the grants, those are free money that is generally, like, that's truly yours. You don't owe it back once you're done. Done. So Maryland Mortgage Program, up until maybe this time last year, had grants and loans.
Okay.
The difference between the two, loans would have lower interest rates.
Okay.
Grants would have pretty significantly higher interest rates. Grants are always a much better option because you didn't know the money.
You have to pay back. Yes.
Suck up the monthly payment for 6 months and refinance out. That strategy is probably why they got rid of
the grants and loans. They're like,
So I have not seen a whole lot of grants still available. Maryland Mortgage Program does do a program called Smart Buy to help eliminate student loan debt.
I want to talk about that too. But go ahead.
The student loan debt, you can eliminate up to $50,000 in it. That's
50 or 15?
50. $50,000. That $50,000 is leaned against your home. That $50,000 it's a forgivable note over 5 years. So we can dive into more of that, but part of that is forgivable. But not many grant options available. Doesn't mean they don't.
And let me just break down another term that we have used, which is like a lien. I always use the idea of a lien like a boot on your car, right? So, if you purchase a car and you don't pay it in cash, you owe the car dealer or the lender the money for your car. But then if you get a ticket or tickets on tickets on tickets, they're going to put a boot on your car, which is similar to that of a lien on a house, right? So you have your primary lien, right, which is your mortgage, unless you're paying for it in cash. And then should you get like a second mortgage or some type of incentive that's a loan, they put a boot on your house. So in order to sell it freely or refinance freely, you have to get rid of the boots on the house or the liens that are on the home. So think of liens like a boot on a car. You can have more than one, right? So some people, you might have heard people say, oh yeah, I have a second mortgage or whatever. Some people might refinance out and then they have a, or they take out a loan on the equity of their home. So that's the difference between what the house is worth and what they owe. So they may take equity out of their home to, I don't know, that's another like buzzword now, which is Airbnb or short-term rentals. And they want to invest in other real estate properties or, increase their portfolio in some way. And so that is a lien against, that's your second mortgage. That's a lien against the equity on your property. Even though the equity is yours, you have not paid the house off in full. And so therefore, the government, the banks, they want their money. Okay? Give them their money. They're going to come for it. I've had clients that have purchased many years ago, decades for some, that have forgotten that they had this loan from when they received down payment assistance from years ago. And here they are trying, and they're ready to go sell their home. And they're like, what is it? What is this on here? Completely forget it. The government doesn't forget. They have it in the archives. It's in the records. It's there. No blackout. No, what happened when a few years back when Baltimore was held hostage? Oh, it was still there. Okay. It's still there. So, definitely like when you're looking to sell a house, you want to consider that those things. We're not talking about selling, but even refinancing. When you pay a house off, let's just say you end up staying in that home 30 years. Well, once your last payment hits, you still owe that money back. That's still a lien. Like you still have to make payments on that. Thankfully, it's non-interest bearing. So it does not collect interest over the time that you have use of this loan, but it's on there. Yeah. And then even the grants and loans have residency restrictions. I always like to add that. It's like everything comes with a price. Yes, you have it, but it might require that you live in the state of Maryland for 5 years, that you live in Baltimore County for 10 years, that you live in Baltimore City for like every different place has its own restrictions. So, that job might come calling, that love may want you to move, and you need to know that when that does happen, do not pass go. Do not collect $200. Give your $200 to whomever. So, yeah, I'm just giving y'all my 2 cents, just things that I have just experienced along the way. And so I know there was one other thing. I was like, oh, Kevin, I want to come back to it. What was it? We were talking about the 2-1 buydowns. We were talking about the incentives. Say that again. Oh, the smart buy. Kevin, that's why you're smart. Yes.
Smart buy is awesome. The way that it works essentially is, one, the requirements. I guess we'll start there because the requirements are a little bit stricter than your standard Maryland mortgage program.
Okay.
You need a 720 credit score.
Mm.
You do need a minimum of 5% down.
Ooh.
And you have to pay off the entirety of your student loan, your federal student loan. And you can pay off up to $50,000 or 15% of the purchase price. Whichever one comes first.
Okay, whichever one. So 15% of the purchase price or up to $50,000.
Yeah.
Okay.
So we'd have to do a little quick math on that to see where the break even is. But I think it's like 405 or something.
Kevin, that's why we have a phone. We don't. All right, so we'll use our $200,000 home reference. So 15% of that would be 30,000. So either 30,000 or so you couldn't get the 50. They're not gonna. If your student loan balance is 30,000, even though it goes up to 50,000, they're only gonna give you 30.
Correct.
What if my student say that on a $200,000 house? What if my student loan balance is 37,000?
You would get up to 30,000, and you have to pay off the other $7,000 at time of closing. Okay. So the entire student loan has to get paid off.
Gotcha.
works out really great for some borrowers. And
Yes.
some borrowers who are in that 100K plus student loan bucket, and they're like, yeah, it's not enough.
It's not going to happen. Yeah.
So I've been lucky enough to help people with a few of the student programs. We get a big check. It's awesome. But the biggest thing is it does have kind of that that residency requirement. Right?
Okay.
It has 5 years. Has a 5-year like forgiveness every 5 years. For every year, excuse me, it decreases by 20%. So
gotcha.
For $100,000, for example, right? I know it's 50, but after year 1, you only owe 80. After year 2, you owe 60. After year 3, you owe 40. So on and so forth.
And so on and so forth. And I wish that program was around. I needed it. Okay. It would have definitely paid off my student. It came after I purchased my home, and I have not had the opportunity to work with anyone to do it yet. Because unfortunately, the folks that I work with, they're like him, 50,000. Yeah. No, I'm well above that. Yeah. Like it is for a select group of people. Like you said, you have to have these credits, a particular credit score. You have to be able to pay off the full thing, so if my student loans was, 32,000, maybe 2,000 wouldn't kill me, but another 7 might, especially if I'm trying to do this 2-for-1 and all, it looks like it can be a lot, but that's
for sure. And if you have 2 borrowers on it, you only have to pay off one of the borrowers entirely as a student. So it doesn't have to be both. You can pay off one entire student loan. The other person can kind of still be chilling.
Gotcha. Or divorce them. Be like, man, I'm debt free. Just take the house. Kevin's like, no, I'm not endorsing that. I'm not saying it either. I'm just being silly, y'all. So, oh man, Kevin, this has been, I'm so full. You know how they talk about, dinner, like the steak and potatoes, like the meat and potatoes, like, I'm glad we were able to just cover some. There were so many other questions that we had. We're going to have to save it for like a part 2. We're going to have to do this again, go live, meet the people, answer some of these questions. But folks, we gave you the piping hot tea today. Evan, we talked about our pre-approvals. We talked about what documents are needed. We talked about DPAs, what we call a DPA is down payment assistance and loan programs and 2-for-1 and home ready and home possible and Maryland mortgage program, the difference between closing costs and down payments. We didn't even really get a chance to get into the different types of mortgage programs. We did speak on a little bit about FHA and conventional and VA and a host of other topics. But the whole purpose of today was to connect you with a professional. This is not Zillow. This is not Google University. Someone who's actually in the trenches, in the streets, knows what's going on and can really give you this information for those that are apprehensive or may have a little bit of anxiety around what's going on in the market, and then affordability, and then discussing this interest rates and what the potential possibilities are if you're getting with the right lender that can move you in the right direction. Okay. So if you got nothing else from here, you've joined us today for an episode of Real Talk and Real Estate with your girl, Kim McBride. It was entitled Marry the House, Date the Rate. But before we go, Kevin, can you please let the folks know how they can reach you?
Yeah. You can find me on Facebook, Kevin Parlett at Direct Mortgage Loans.
Okay. How you spell your last name?
Parlett.
Okay.
Find me there. You can find me on my personal page on Facebook, just Kevin Parlett. Same on Instagram. My email is kparlett@directmortgage, and then my number is 410-459-9299. Call me, text me, just let me know. If you have any questions, I'm here to help and help the best I can.
Yes. Kevin, thank you so much. I'm so glad. Those that don't know, Kevin and I have never met in person because of the pandemic. It's the pandemic's fault, but we have been in communication a lot over the past year and a half. And again, just exemplary in what he does. Like, his bio isn't just fluff. Like, he legitimately is the person that I told you about in the beginning of this podcast. I'm so honored to have been able to share a part of your day with you. And thank you everyone for tuning in to another episode of Real Talk and Real Estate with your girl, Kim McBride. You can find me anywhere. Okay. I'm trying to get down with this TikTok, y'all. So I'm TikTok, Get Keys with Kim, Instagram, Facebook, LinkedIn, all of it. Get keys with Kim. I mean, what? It's a command, right? I'm telling you what you need to do. And what are you going to do? Get keys with Kim. All right, you all. Have a great rest of your day and make it a great day on purpose. Thanks so much for joining me.
See ya.
Bye. And that's a wrap, folks. Looking forward to you guys tuning in another 2 weeks for a new episode of Real Talk and Real Estate with your girl, Kim McBride. Have a great day.